Today, it's more about marketing than markets. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and property news with a distinctively Australian flavour. Well, reflect on this. At the start of 2022, no one said the market would peak on the first day of the calendar year and go downhill from there, and that central banks would be hiking rates like crazy. Sure, some were talking about a major market correction, but then they've been on that ale for, well, probably a decade now, and others talked about a small market fall or a rise in bond yields. So when you hear or read about an investor's expert outlook for the year ahead, bear one thing in mind: every forecast about 2022 was wrong, totally off. So perhaps we should also expect forecasts for 2023 to be equally miscalculated, as a recent MarketWatch article discussed. The point is this: market strategists and economists don't make forecasts because they want to, but rather because they have to. Keeping their jobs depends on making actually mostly lame predictions. Most forecasts lack insight, gravitating towards the middle ground or to obvious observations on the effects of economic and stock market cycles. And of course, they change their tune as often as they wash their shirts. And are they accountable for the predictions? Well, not at all. Howard Yaris, a New York University professor and author of a recent book, Understandable Economics, said, "If you're talking about a fine-tuned forecast about stocks and asset values, I don't see how anyone could go there. Accurate predictions aren't going to happen, or will be luck if they turn out true. Their statements are more about marketing than the market." And Bill Berger, founder of the Berger Funds, which merged into the Janus Funds in 2002, cited what he called the two rules of forecasting. Rule 1, for each forecast, there is an equal and opposite forecast. Rule 2, both of them are wrong. It looks bad if they don't have an opinion, but worse when they get something wrong. So most forecasts say as little as possible, said Jeff Rosenkrantz, a fixed income portfolio manager at Shelton Capital Management. You're not getting much insight. If they have really valuable insights, this isn't where they want to tell the world. So most forecasts aren't worth much at all. The truth is, credibility is impossible without accountability. But he acknowledges the tightrope experts walk if they say too much. There's wordsmithing going on. You word them so that you have a noticeably higher than 50% chance of getting them right, and then say a few things you believe in that will make you look really smart if they happen, without making you look dumb for believing it. Bob Dole, Chief Investment Officer at Crossmark Global Investments, said, "Good forecasts are not just an academic route exercise," Dole said, "provided they're relevant, they prompt thoughtful reactions from the audience, and that the experts stand by them." Dole revisits his forecasts every quarter and doesn't alter them in response to current events. "You call the beast as you see it," he says, "and then you stand by it and live with it, and you don't worry about getting them all right, because if you haven't gotten something wrong, you've only said the obvious." So, should we just ignore the forecasting noise, which is now ever louder thanks to social media and instant 24/7 news bites? Well, maybe in the short term that would be smart, because with a trading mentality there's a 50-50 chance of being right. However, reflect on this. Back in 1995, Berger had worked in investments for 45 years, and when he got started the Dow was below 200. Mathematically, he saw the Dow's future as reflecting the past. Repeating the growth he'd lived through would push the benchmark to 116,200 over the next 45 years. A septuagenarian at the time, Berger wryly suggested that if he was proved wrong, people could find him to discuss it. Sadly, of course, he died a few years later. Despite the outlandishness of the forecast, Morningstar calculates that hitting the target would have required an annualized gain of roughly 7.35% over the 45 years. When the Dow peaked on January the 4th, 2022, the necessary gain was down to 6.33% annualized, and as at December the 1st, Morningstar calculates that hitting the 116,200 in the fall of 2040 would take a 7.07% annualized gain. So perhaps it's worth looking through the short-term volatility and uncertainty, because on one hand, long-term investors benefit from inflation, growth, and compounding. So be in the market long-term. Yet on the other hand, given the massive injection of, quote, liquidity from central banks and governments since 2000, with spikes during the global financial crisis and through COVID, the pressure of more dollars, or other currencies for that matter, chasing the same assets explains the massive run-up in asset values to levels not ever seen before, supported of course by massive amounts of debt. But that also translates to higher inflation. Yes, folks, the central banks created the inflation they're now trying to tame. COVID, Ukraine, or other factors were mere excuses trotted out to provide a suitable alibi. So here, as the punch bowl is removed, meaning higher interest rates, asset prices across property and shares are likely to fall, and could fall hard, in which case being out of the market and liquidating assets makes more sense. This is, of course, the Harry Dent future, where beyond the fall lays opportunity. And as for 2023, well, either of those futures are possible, but just remember, we should expect forecasts for 2023 to be as equally miscalculated as those for 2022. Why? Because this is much more about marketing than markets. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.